Thank you very much for welcoming to Milestone African Motives. Today, we are going to talk about the creditors payment schedule, which is accounting grade 12. We are on revisions. We are trying by all means to prepare ourselves. So let's make sure that we are going to be together from the start of this presentation and to the end of it. And let's make sure that we are going to share with others, and we are going to also make comments where necessary. So without wasting much time, let me get to the instruction that we are given here. You are provided with the information related to chalk chip biscuits for the forecast period from 1 January 2022 to 31 May 2022. The business sells biscuits which has a shelf life of 1 month. That is that. So we are required now 2.1, complete the table on your answer book to calculate the gross profit from January to May 2022. Calculations must be rounded off to the nearest rand. So that is that. So we have to calculate what gross profit from January to May 2022. Also prepare creditors payment schedule. Also, we are told if the expected yearly cost of 6,500,000, calculate the number of months for which there is enough stock on hand and explain whether this is appropriate for the business or not. Give 3 disadvantages of keeping too much stock. So these are the questions that we are to answer. So now let's quickly go to the information. So here we are given the information. Here is our information. We have total credit sales. Total credit sales, 420,000, 432, 450,000, 456,000, 457,000. Those are our total credit sales. So it says 60% of sales were on credit and 40% were cash sales. So it means that this 420,000 is already 60%. It's already the 60% of what? Of credit sales. Because we are told that these are total credit sales, these ones. So what we don't know is the amount for cash sales. But for credit sales, it's already calculated. As it says, 60% of sales were on credit. And we are told here, these are the total credit sales. So that is that. So let's move on. So here we are under additional information. Here is our additional information. So the additional information says all goods are sold at the markup of 33.25% on cost. 33.25% on cost. Credit purchases amount to 80% of all purchases. Creditors are paid as follows: 70% in the month of purchase and earns 2.5 discount. 30% in the month following the purchase. And stock will be replenished monthly, and the company aims to keep fixed base inventory level of 500,000. So that is the information that we are given. So without wasting time, let's quickly go to workings and do the calculations of what we are given. Here we are under our workings. As we can see now, we have what? We have cash sales of 280,000 from Jan February 288,800, 300,000, 304,000, 304,000. So you don't know where are these church sales coming from. But you know the credit sales because the credit sales already is given that those total credit sales. But where did we get this 280,000? That is very important for us to calculate it. Already we have said we know what total credit sales. We are given a total credit sale is equal to how much? Let's start with 420,000. Then to a percentage of sales credit, we were told that is what? It's 60%. And the percentage on cash, it's how much? It's 40%. This one is percentage on credit. This one is on cash. So now we want to find what? The cash sales now. So we are going to denote total sales as X. Since 60% of total sales equals to 420. We know for sure that the 60% is equal to 420%. That is that. We know that the 60% equals to 420%. 420,000. So it means now we're going to put this 60% in decimal. We're going to say 0.6x 0.6x is equal to 420,000. And then we are going to say x is equal to 420,000 divided by 0.6. Then our x now will be equal to 700,000, which is going to be our total sales. So now we are going to say 40% times 700. We are going to say 40%. So 40% in this mass is 0.4 times 700,000. Then it will give us 280,000. So that is how we get or calculate or to get what the cash sales. That is how we calculated our cash sales, which is 280,000. So even when we go to February, March, April, May, we are still going to do the same thing. We are still going to do the same thing. So that is how we get our chest sales. So when you add this chest sales plus credit sales, then they will give what 700 our total sales. Also from February, the same thing. When you add chest sales and credit sales, they will give you all these totals that are given here. Hope we understand each other. So now we are coming to the cost of sales and try to find out how did we get to the 525,000. How did we get to 525,000? That is very important. 525,000. So now we are trying to find out the cost of sales. We are trying to find out what the cost of sales. So as we are going to calculate the cost of sales, we know the markup percentage. If you can still remember, we know the markup percentage. We know the markup percentage, which is equal to 33 and quarter percent, which we were given under additional information. We can go and then see where did we get that from. This is our markup percentage that we're talking about. We know our markup percentage. Also, we know our selling price, our total sales. We know our total sales of what? Of 700. Of 700, which is this one. This is our total sales of 700. So now we are going to say selling price wherever we're talking about the total sales is how much? 700,000. So now we need to convert markup percentage to decimal. We need to convert our markup percentage to decimal. So when you convert our markup percentage to decimal, it's going to be, when you're saying 33 and quarter percentage into decimal, it's going to be it's going to be like this, which is approximately 0.333. This is our markup percentage. So now we are going to try to calculate the multiplier. So we need to have what? Multiplier. So our multiplier here is going to be our multiplier is going to be equals to 1 plus markup percentage. 1 plus markup percentage. That is that. So we are going to say 1 plus 0.333, which is going to give us 1.333. But one can ask, why do we add 1? That is very important again. Important question. Why do we add 1 to markup percentage? That is very important that we have to know that. So we add 1 because the 1 represents the original cost price. 1 represents what? The original cost price. We know that our goods are produced at 100% of the cost. So the 1 that we are adding represent what? The original cost price. So that is why we're going to say 1 plus the markup, because the markup percentage now is what? 0.33, which represents the additional amount that added to the cost price. So hope this makes sense to you. So now we are moving on. So now when we are on this step 3, then we are going to say cost of sales is equal to selling price divided by multiplier. Selling price divided by multiplier. So our cost, our selling price is 700,000 divided by now 1.333, which is going to give us what? 525,000. So this is our cost of sales. This is our cost of sales, which is this one. So we are going to do the very same thing with February, March, April, May. We are going to do the very same thing when we calculate what? The cost of sales. That is how we came up with these amounts under the cost of sales. Remember, cost of sales, they are in bracket because the business incurred some cost, they reduced what the business uh, revenues. So they are in brackets as to show that they are going to be subtracted from total sales for us to get what? The profit that we were asked to calculate. So that is that. Now we are coming to the cash, where right now we say cash 20%, credit 80%. So let's go to the information that talk about those percentage. Let's go to the information which talked about this 80%. Here it is. We're told here that credit purchases amount to 80% of all purchases. Credit purchases amount to 80% of all purchases. So it means the cash is going to be 20% to make it 100. It means if 80% is for credit to the amount, all purchases purchased on credit, it means 20% will be of the cash sales. Of cash sales. So that is why we have all this. So we are going to say 20% of what? Of our cost of sales, then it will give us this much. 20% of 540,000 from February, it will give us this much. From March, it will give us this much. From April, it will give us this much, and May as well. So if in the 80%, we are going to do the same. If in 80%, we are going to do the same. So it means that 80% of 525,000, it will give us how much? It will give us 420,000. So this represents the portion of the cost of sales that were purchased on credit. This represents what? The portion of the cost of sales that were purchased on credit. That is why we have what? 420,000. Here we have 432,000, which is the 80,000 of 540,000 of cost of sales. So it simply says the 432,000 represent a portion of the cost of sales that was purchased on credit. Also, even in March, 450,000 represent a portion of cost of sales that was purchased on credit. Here, even on April, 456,000 represent a portion of the cost of sales that were purchased on credit, as well as May, 457,200 represent the portion of cost of sales that were purchased on credit. Hope we are together. While the 20% of 452,000, which is 105,000, is going to represent what? The portion of the cost of sales that was purchased on cash. Also, 180,000 it represent the portion of cost of sales that was purchased on cash. That is how this will to be explained to you. So now we are moving on, whereby we were told on our information that we are having those percentages, 70% as well as 30%. This is what we are talking about. This is our 70%, where we were told 70% in the month of purchases to earn what? 2.5 discount, 30 in the following month. So this is how we are going to write them, as these are the budgets, because these are the budgets. So this is that 70%. It means it will be in January, And then February we have 30%. Coming to the next month, the month of the sale is now going to be on February. We're going to start our 70 here on February. Then the month that follows is what? 30%. On March, the month of sale is what? The 70%. And the month that follows is what? 30%. Just like April as well as May. So that is that. So now we are to move on. Now we are to move on to our answer book now. We are to move on to our answer book. Here is our answer book. Complete the table on your answer book to calculate the gross profit from January to May. Calculations must be rounded to the nearest red. So now we are asked to calculate what? The gross profit. We now know our total sales. Total sales for January is 700,000. 700,000. For February, 720,000. For March, 750,000. April is 760,000 and May is 762,000. So our cost of sales that we calculated, remember we calculate the cost of sales that we are going to subtract, which is 525,000 for January. For February is 540,000. For March, 562,500. For April, 570,000. For May is 571,500. So these are our sales. You know, for us to get profit, we're going to say sales minus cost profit. We are going to say sales minus cost profit. So those amounts, these sales amounts and cost of sales amounts, they are here on our calculations. Here are those amounts. This is our sales amounts, total sales amounts, and these are our cost of sales that we calculated. So we are going to say sales minus cost of sales. Then we are going to get what? The profit. So now we are to say 700,000 minus 525,000, and then it will give us what? It will give us 175,000. 175,000. 175,000. Then for Feb, it will give us 180. To give us 180,000. For March, it will give us 187,500. For April, it's going to give us 190,000, and May is 190,500. 190,500. So that is how we calculate our profit. Hope we are together on that one. So now we are going to move on to creditors payment schedule, because we're asked to do the creditors payment schedule. We're asked to do creditors payment schedule. So we are going to try to calculate it. So as we are told to calculate to do creditors payment schedule for March, because these are the budgeted months, March, April, May. So it means you're going to only focus on March and April and May. So as it is like that, and we were given the percentage that you're going to work with. So it means you're going to start from February. We are going to start from February. So it's very important to know the credit purchases of February to May. So the credit purchase of February is 432,000. 432,000 for March is 450,000. April 406,000 and May 457,200. So these are our credit purchases. These are our credit purchases. So now we want to calculate what? We want to calculate for March now. We want to know the creditors payment schedule for March, April, and May. So that is what we are going to do now. So our month of sale is what now? It's March. Our month of sale is March. So now let us go to this information and try to see. Here it is. 70% in the month of purchases. So the month of purchases is what? Now is going to be what? It's going to be March. You're going to start to March. So the month of purchases is March, and it is to earn what? A 2.5 discount. It is to earn 2.5 discount. And then 30%. 30% in the month of the following purchases. So here the month of sale is what you're going to start with March, whereby you are going to earn what? 2.5 discount. So before we can even go to the answer book, let us see how we are going to calculate this. This month of sale where we have 70%. So it means now we have to subtract this 2.5 discount, whereby if it's 2.5, we're going to say in 100, we're going to say minus 100 minus 2.5. 100 minus 2.5. So we are going to say 100 minus 2.5, because we have to subtract this discount that you are to earn on the month of purchases. So we are going to say it's going to give us 97.5, and then in decimal, when we convert it to decimal, then it will give us this much. Then we are going to say 70% multiplied by this 0.97, it is going to give us this much. So we are going to convert this into decimal. Then we are going to have this much. This is the percentage we are going to use when we calculate the amount for of the purchases on the same month. Of the purchases of the month of the purchases. So now let's move on and try by all means to go to our answer book now. So remember that the 30%, we were told about the 30%, that 30% in the month following the purchase. So now we are going to start with the 30% in the month following what? The purchase. So we are going to say 0.3. We are going to say 0.3 multiplied by 432,000. 0.3 multiply by 432,000, then it will give us 129,600. So then we are going to write it here, 129,600. Now we come to the month of purchases, where we were told that we are to get what? 70%, where we were told to get what? 70% in the month of purchases and to earn 2.5 discount. And then we already subtracted the 2.5 discount and we managed to get this amount, 0.6825. 0.6825. So we are going to say 0.6825 multiplied by the credit purchases of March, which is the month of purchases, 450,000. Then it will give us 307,125. So that is that. 307,125. That is how we are to calculate it. So now we go straight to the April now. Now we are on April. So for April, we're still going to do the same thing, same procedure, whereby now we are going to say, for us to get to April, we're going to start by March. Now we are going to say 0.3 multiplied by 450,000. Now it will give us 135,000. It will give us 135,000. 135,000. Then we come to the month of purchases now. Now the month of our purchases is now April, because it was March. Now it is now April. So we're told that for April, we're going to use which percentage? We are going to use this percentage for the month. This is a percentage for the month of purchases that we are going to use. So it means we're going to say 0.6825 multiplied by the credit purchases of April, which is 456,000. And it will give us how much? 311,220. 220. So we're going to write it here on the month of purchases, which is 311,220. So that is that. So now we go to, this is for April. This is for April. This is for March. Now we are coming to May. So now we are on May. So under May, we are now going to start through April. We are going to say 0.3 multiplied by the credit purchases of April, which is the credit purchase of April is 456,000. 456,000. So 456,000 now is going to give us 136,800. Going to give us 136,800. 136,800. That is the amount for the month following the month of purchases. 136,800. That is that. 136,800. 36,800. So now we come to the month of the purchases now, which is now May. So May, remember the percentage that we use for the month of purchases is what? 0.6825 multiplied by the credit purchases of May, 457,200. And then it will give us what? 312,039. That is 3,012 and 39. So that is that. Then we are to give what? The totals now. So we are going to add, starting with March. So the payment to creditors to March is going to be 436,725. For April, it's going to be 446,220. For May, it's going to be 448,839. So this is how we were asked to calculate the creditors payment schedule for these 3 months that were budgeted. So now we are to move on to another question. As you remember that the other question was to calculate, we did answer 2.1 where we managed to get profit, and then we also managed to do what? The creditors payment schedule. So now we are asked to calculate the number of months which there is enough stock on hand, or explain whether it is appropriate for the business. So statement was written as follows: if the expected yearly cost of sales is 6,500,000, calculate the number of months which there is enough stock on hand, and then explain whether this is appropriate for business. That is what we are asked to do. So meaning we are going to do what we call stock holding period. We are going to do what we call stock holding period. That's what we are mainly going to look at. So for us to do that, we have to remember that we were told that the stock will be replenished monthly. So the company aims to keep fixed base inventory level of 500,000. So for us to calculate that stock holding period, we are going to simply say here is our stock holding period. So we are going to say 500 that we are giving, 500,000 divided by 6,500,000. Multiply now by 365 days in a year. Then it will give us 28.1 days stock holding period. That is how we were to answer it. So the 500,000, you will remember very well that this is this amount. This one, we are using 500,000, which we are told that the company aims to keep fixed base inventory level. This is the inventory level. So we are going to say that inventory level, then divided by 6 million that we are told about, which is the expected yearly cost of sales. So then it will give us what it gave us, which is 28 days. 28 days. So that is our correct answer. So now we move on to comment. It says comment if this is appropriate for the business. So your comment will be, yes, it is appropriate. Yes, it is appropriate because the period of stock on hand is less than 1 month. The period of stock is less than 1 month. As you can see, it is less than 1 month as we are told that this 28 days. So it is appropriate because we are to, when you go to this information, we were told here that the business sells the biscuits which has a shelf life of 1 month. Must have what? A shelf life of 1 month. So now it is going to stay for 28 days. So it means it's appropriate. It is not going to stay for long there in the shelf. So it's less than 1 month because it's 28 days. So it is very appropriate considering this instruction or the statement that we are told that the business sells biscuits which has a shelf life of 1 month. So that is that. So now we have answered this 2.3. So now we have to give 3 disadvantages of keeping too much stock. Keeping too much stock. That is 2.4. We are to answer 2.4. 3 disadvantages of keeping too much stock. So it means the inventory can become obsolete. The stock or inventory can become obsolete. It can now expire. Also, inventory can go out of fashion. The stock can go out of fashion. Also, too much working capital into inventory. Too much working capital into inventory. So that is how we were supposed to, or we are expected to answer this question. That is how we expected to answer this question. So that is the end of this presentation. Thank you very much for your time. Make sure that you are going to use this presentation as a preparation for your exams. Thank you very much. Make sure that you are going to share it. You're going to share this presentation with others, and don't forget to hit the subscription button. Thank you.